All right. Good morning, everyone. Good afternoon, I guess, if you are in Europe, and good evening if you are in Asia. I hope all of you are doing well. Um, when we started this seminar series, I thought I would not be doing this moderation job, but I think my committee members decided finally to put me into the mix. So thanks once again for the wonderful response that you all have given to this initiative. We are very grateful for that support, and we just actually put out a call for papers for which we have set a deadline for November 18th. So I encourage all of you to please submit your work for the spring seminar series. Today we are very happy to have Xing from Aarhus University and also at the Danish Finance Institute, who would be presenting his work on horizon-based decomposition of mutual fund value added using transactions. The rules of the game are pretty much the same if you have attended the previous seminars. But for those of you who are new, if you have any questions, feel free to put it in the chat box, and at an opportune time, I will direct them to Ran, and he can answer those. But if you have a follow-up question, I'm happy to unmute you, and you can ask a follow-up question. Ran has kindly agreed to do that. And then after the seminar, I'm just going to stop the recording, which I have started, and my committee members reminded me of doing that. We will post the YouTube video later on. And then, after the seminar, we usually hang around for another 15 minutes in case people want to chat with the speaker. So at that time, the recording will stop and you can have an informal conversation. So I'll stop here and let Rand take over. Okay. So looking forward to it.
Okay. Yeah. So firstly, thanks everyone for being here after an exhausting night, and hopefully we can have a relatively easy time here together. So the paper I'm going to present today is called a horizon-based decomposition of a mutual fund value added using transactions. So it is co-authored with Jules van Binsbergen from the Wharton School, with Zhuangshu Han from Stockholm School of Economics, Hong Xunruan from Peking University, and here's myself from Aarhus University and from Denmark. Yeah. So let me first motivate our research with the dispersion of fund turnover in the active managed mutual fund industry. So for this table shows the turnover rate of active managed mutual funds in the US. So we have a fund called Berkshire Focus, which has an annual turnover as high as 980% per year. That means this fund changes its portfolio like 10 times per year. And we also have a fund like BlackRock Mid Cap Growth, which has an annual turnover of only 38% per year. That means it changes its portfolio once every 2 to 3 years. Yeah, so they use quite different turnover strategies. However, when you have a look at their perspectives, you will notice like most funds have exactly the same investment objective, that's to seek capital appreciation. Yeah, basically, most of them want to earn as much money as possible, right? The question is, if they have exactly the same target, how come they're using completely different strategies? Is it the case like some funds are specializing at a relatively short-term investment opportunity and some funds are specializing at a longer-term investment opportunity? Or it is simply like some funds are trading too much and wasting the cost and energies for nothing? Yeah. So be more specific, the research question of our paper is, do mutual funds specialize and add value at different investment horizons? So our work is partially motivated by a growing literature on the specialization in the asset management industry. So nowadays it's more about theories. Yeah, one of the first theories starting from Van Nieuwenburg and Veldkamp 2009, which shows like there are specializations in information acquisition at the country level, industry level, and perhaps also at stock level. And the recent paper from Cruzet, Dubecker, and Nathanson extended their model and shows that there are also specializations endogenously at different investment horizons. So from my view, I think the specialization perspective complements our current understanding of the mutual fund industry, such as the well-known literature on decreasing returns to scale, which is first proposed by Burke and Green, and it is focusing on the fund size instead of their strategy. But there have been mounting empirical evidence on that. For example, Yan 2008, Zhu 2018, and a very recent and very nice paper from Barras, Gagliardini, and Skylett 2020. And also there's another thread, goes one step further, shows large funds trade liquid stocks, diversify more, and trade less to accommodate for the decreasing returns to scale. So it is one of the paper includes the well-known paper from one of our organizers, like Booster called Jiang and Tang 2020, and also other papers include Paulit and Wilson 2008, and also Pastor Stamble and Tyler 2020. So in this work, I want to focus and also emphasize the difference between trading the same investment opportunity less and specializing at different investment opportunities at different horizons, because they will have different implications that we want to say. So for the empirical part of this paper, it is closely related with the mutual fund literature using quarterly holdings data and transaction data for the analysis of scale. So for those who have worked in this area, you may have noticed there is a large disconnection in the literature in terms of the data source and in terms of the methodology. So for those papers using quarterly holding data, they rely on quarterly snapshots of portfolios, and that largely neglects the short-term holdings and the trading cost and the price impact cost. Well, the literature using transaction data are largely relying on anonymous data from institutional investors, and that neglects the long-term holdings of those funds. And for our work, we're lucky enough to have the transaction and daily holding data for a small sample of US mutual funds. So we can cover both the short-term holding and long-term holding in the same framework. And there are also quite some inconsistencies in the methodologies of these two threads of literature. So for example, quarterly holding data, rely on actual holdings, while the transaction literature rely on hypothetical holdings, assuming that the fund is buying and keeping the stock for a certain time period. And also each of the thread only capture a fraction of trade's effect on the fund performance. So what we do in this paper is we first propose a model featuring horizon-specific scale, and where a fund chooses its holdings based on not only its scale and also the price impact of their trades. And empirically, we construct daily holding data for the empirical test by merging the transaction data with the quarterly holding data using the method shared with us by Busher, Claudia, Jiang, and Tang. And we decompose the value added of holdings by the past length of holding period. We find that using this method, we can reconcile the inconsistencies between the quarterly holdings literature and transaction literature. And we do that at daily frequency from 1 day to 1 year. And because we know the identities of the funds, we can do the analysis and compare the decomposition across fund categories. So we compare high turnover funds with low turnover funds and small funds versus large funds. So our main findings can be summarized as below. So theoretically, we find that funds choose their turnovers based on their horizon-specific scale, which is measured by the value added measure that is first proposed by Burke and Van Binsbergen in 2015. And that takes horizon-specific price impact cost into account. So not only alpha, but also the price impact cost. Yeah. And secondly, our model predicts that fund turnover positively correlates with the short-term value added and negatively correlates with the long-term value added. And also that the fund turnover positively correlates with the price impact cost. So empirically, we find a consistent result. Yeah, we find that holdings of high turnover funds add substantial value in the first 2 months, while holdings of low turnover funds mainly add value beyond a year. Yeah. And also the price impact cost of high turnover funds are substantially higher than that of low turnover funds. Yeah, consistent with our model prediction. Yeah. So let me firstly go through the model. So for the model, we extend the simple version of Burke and Green's model with dynamic trading. Yeah, so here in our model, we have 2 types of investment opportunities. Yeah, the H can either be S for short-term or L for long-term investment opportunity. And each with an investment horizon of TH with like TS for short-term, shorter than the TL for long-term. Yeah. And each opportunity pays a risk-adjusted return of RH, which has an expected value of alpha H, with a random term of epsilon H at the end of the investment period TH. So upon the payoff of each investment opportunity, the fund need to find a new investment opportunity and choose it between either the short-term and long-term, and choose the amount of capital to invest in. That's the QH. So, given the amount of capital is chosen, then the fund needs to choose the investment amount in each period. Yeah, what we call is the trading policy. That is like the amount to invest in each period, like W1, W2, until WTH. Yeah, those are the investment periods until TH. So the investment amount should be non-negative and sum to QH. That's the total amount they invest in this opportunity. In terms of price impact cost, we use the quadratic form of price impact cost, and we use B for the price impact cost parameter. Yeah, we assume that is the same for all investment opportunities because we're focusing on the differences of price impact cost across horizons, instead of like across stocks. Yeah. So given the choice of QH, that's the amount of capital to invest in that opportunity, and also TH, so that's a horizon or the investment period of that opportunity. Yeah, the fund's value added or the value function can be expressed as below. So here, the value function JH equals to the first term for the present value of a future price impact cost of investing in this opportunity TH. And the second term is the present value of the payoff of that investment opportunity. And the third term is for the continuation value. Yeah. So we notice like even though we maximize the entire value function, we start from the first part, that is the trading policy, given their choice of the amount of capital going to be invested. Yeah. So where J here is the continuation value, which is the maximum value from GS, that's the value of investing in the short term, and the JL, that's the value of investing in the long-term opportunity. And then if we fix and take the second part as given, the optimal trading policy can be pinned down to minimizing the trading cost. Yeah, that's minimizing the present value of the trading cost. And what's need to be decided is the amount to be invested in each period.
Ran?
Sure.
Yeah, we've got a first question from Shugato Ray. He's asking, I would imagine that B would be heterogeneous across stocks and be linked to a trading horizon. That is, if I invest in an illiquid stock, then I would have a longer horizon.
If you invest, yeah, definitely. There are interactions between the stock liquidity and also like the horizon of the investment, because that's a joint decision. Well, because in the other papers, like Booster, Collier, Jiang, and Tang, they're focusing more on the liquid stocks and or like focus on the the liquidity discussion, in our paper, we try to focus on the horizon. Yeah, I think both channels work and there are interactions. I agree on that. Yeah. Okay, now let me continue with the model. Like for the model part, we try to first solve the optimal trading policy to minimize the present value of the trading cost. Yeah. So the optimal trading policy is given by lemma 1. The intuition is quite simple. That is, the funds will spread their trades over time and also take the discounting factor into account. Yeah. So here is like the optimal trading policy of investing QH in opportunity H is given by W tau star here, which is QH divided by this parameter called gamma H. So here we can see from the expression of gamma H, which is increasing with TH and also is decided by discount factor. Yeah, so we can take the extreme case, that is like when there is no discounting, that means like when beta goes to 1, then the gamma H is simply equals to TH. So that is the spreading of trades over time. And the present value of price impact cost will be also a function of gamma H. Yeah, the intuition is simply the longer time period you have for this investment, the more you can spread your trades over time. And then the less you need to pay in terms of the total amount of trading costs. Yeah. So let's just look at the limiting case directly. So the limiting case of lemma 1, that's when the discounting goes to 1. Yeah, that means no discounting. Then the optimal trading policy is given by QH divided by TH. That means the fund simply spread its trades equally over time. Yeah. And the trading cost will decrease as the investment period or the length of the investment period increase because they can spread their trades equally over time more. Yeah. So that generates the heterogeneous price impact cost across different horizons. And then under the optimal trading policy, we substitute the expression of the trading cost into the value function and get the following expression. And assuming that the fund is repeatedly choosing the same investment opportunity. In the paper, we have proved that under our assumptions, if a fund chooses short-term opportunity from the start, they will continue to choose short-term opportunity. And if a fund chooses the long-term opportunity, and they will continue to choose a long-term opportunity. So here, like if we use the same GH hat here, represents the value function of choosing opportunity H, and we can solve this value function for the expression of J. So if we solve it, basically the structure and also the expression of J resembles the structure in Burke and Green's model. So we have a well-known expression like the value added equals to the alpha of that investment opportunity multiply the fund size QH. And the second term is a decreasing return to scale. That's like here in our model is price impact cost multiply the fund size to the power of TH. So more specifically, because what we have is a dynamic setting. So the alpha H or the AH here in our model actually represents the compounding alpha from reinvesting in H. So that's a dynamic setting of the alpha opportunity. And the BH captures the present value of price impact cost. Yeah, that also is the discounted value of all the potential future price impact cost for this investment. And from BH here, we can see that is also dividing gamma H. That means like the longer investment period you have, basically the more you can spread your trades over time and the less you need to pay in terms of the price impact cost. So we have a BS here larger than BL because investing in longer term, you can spread your trades more over time. Yeah? And if we divide the value function GH hat here by the QH, that gives you the well-known expression for the growth alpha in the Burke and Green's model. So the growth alpha of a fund is simply the alpha opportunity minus the price impact cost multiply the fund size QH. Yeah. So now we have our corollary 2 that will be used a lot in our predictions later. So that is under the optimal trading policy given in lemma 1, price impact costs are larger for the short-term opportunity than the long-term opportunity per unit of investment. Yeah, that is BS larger than BL, because investing in a longer-term investment opportunity that you can spread your trades over time more. Once we have solved the optimal trading policy, and then we can go one step back and then solve the optimal size of actively managed capital that the fund chooses to invest in. So here, what we need to do is exactly the same as Berg and Green's model. It's like you just take the first order condition to the value added function, and then you can solve the optimal amount of capital to invest actively. That's a QH star, which equals to the alpha H AH divided by 2BH. Yeah. And then by substituting this optimal size of active investment into the expression above, you can get the value added under the optimal choice. That's the AH squared divided by 4BH. And the corresponding optimal growth alpha, yeah, for the active part is AH divided by 2. Yeah. So after solving the active part, we already have, okay, yeah, there's one thing I forgot to mention. Is like, just like in Berg and Green, like the fund cannot directly choose its size. That's the QH star. So in Berg and Green, they say you can, the fund can choose the fund size indirectly by choosing the optimal fee. So in Berg and Green, they assume like rational investors chase any positive net present value opportunities. So funds have a net alpha of 0. That means like the gross alpha should equal to the fee, gives a 0 net alpha. And if the fund picks its fee, optimal fee F star equals to the optimal gross alpha, alpha G star equals to the AH divided by 2, the investor will choose to invest this optimal amount of capital QH star into the fund. That's AH divided by 2BH into the fund, and the market is in equilibrium. That means the alpha and net alpha equals to 0. And so it's the same as the Berg and Green setting here. So based on these results, we have our proposition 1. That is the fund chooses the short-term opportunity if and only if the value added of investing in the short-term opportunity is higher than the value added of investing in the long-term opportunity. So here we can see the value added depends not only on the alpha, that's the AS square, but also on the price impact of BS. Yeah, so different from using alpha directly as a measure, here using value added, you also take the price impact cost into account. So that is the key of understanding the decision of choosing investment opportunities at different investment horizons. And so in proposition 2, we focus on the alpha part. Yeah. So the proposition 2 tells us like choosing short-term opportunities implies that the fund's short-term alpha is greater than its long-term alpha before price impact cost. Yeah, that is AS is larger than AL. However, choosing long-term investment opportunities does not necessarily imply that its long-term alpha is greater than its short-term alpha before price impact cost. Yeah. So I think it is better explained in this formula. It's like if a fund chooses short-term investment opportunity, like in proposition 1, it's because the value added of investing in short-term opportunity is higher. So that's this equation. And then because both AS and BS and also AL and BL are positive, so this inequality holds either because AS is larger than AL or BS is smaller than BL. Yeah, but because the corollary 2 tells us the BS, the price impact cost parameter of investing in short term, is larger than BL because of investing in longer term opportunity, you can spread your trades over time more. the only possibility for this inequality to hold is like a fund has a larger short-term investment alpha than long-term investment alpha. So that tells you the fund chooses to invest in short-term opportunity simply because the short-term investment opportunity has a higher alpha. But on the other hand, that's not the case for a fund choosing long-term investment opportunity. Yeah, because from this expression, you will know the fund choose long-term opportunity, either because the BL is larger than BS, is smaller than BS, or because AL is larger than AS. So assuming that for one fund, the opportunity of investing in long-term and the opportunity of investing in short-term have the same alpha, still because like the cost of investing in longer-term opportunity is lower than the cost of investing in short-term opportunity, the fund will choose to invest in the long-term opportunity. So that means it's entirely possible, and maybe in most of the cases, like the fund chooses to invest in long-term opportunity because of the lower cost, instead of because of the higher alpha. So that tells you the differences between the value-added measure and the alpha measure, and because the value-added measure takes the price impact cost into account. Now, for the third proposition, we shift our discussion to the price impact cost. So in proposition 3, it tells you the present value of equilibrium price impact cost, which is measured as a percentage of total trading amounts, can be represented as a function of only the fund's alpha. So it might sound a little bit expressed at the beginning, but the intuition is quite simple. Like for the price impact cost, basically the expression is the BH multiply QH star. That's as a percentage of the trading amount or the investment amount QH star. By substituting the QH star AH divided by 2BH, that's the optimal fund size, into this expression, you get the PIH, price impact cost, is only a function of the alpha opportunity. So the reason we get this result is because a fund will only choose to trade if it has an alpha opportunity to profit from. So assume that there is no alpha opportunity on the table, the fund will simply not choose to trade, whatever how high or how low your price impact cost is. So in equilibrium, the price impact cost is only decided by the size of your alpha opportunity. And this equation gives us many predictions in terms of the relation between price impact cost and fund turnover. And so the most important one is like the price impact costs are higher for high turnover funds. So firstly, because in proposition 2, we have already shown that the fund chooses short-term investment opportunity because of a higher alpha, right? That means like alpha S is larger than alpha L. So for price impact cost, which is only a function of alpha, that the PIH, the price impact cost of investing in opportunity H, is higher for a fund investing in a short-term opportunity than in a long-term opportunity. So here is an unconditional correlation between the price impact cost and the turnover of the fund. But on the other hand, if we just focus on the first expression, that the BH multiply QH star as the expression of the price impact cost, we know fixing the size QH star here, the price impact cost is also higher for a fund investing in short-term opportunities, because of our corollary 2, that's a BS larger than BL. So that means like assuming they invest the same amount, the short-term investors need to pay more or higher price impact cost because they cannot spread their trades over time too much. And on the other hand, this equation also tells us the relation between PIH and the fund size QH star, right? So we can see that the price impact cost increases with the fund size, and the speed of increasing or the slope depends on the price impact cost parameter BH. We know that BS is larger than BL again, that the price that tells us the price impact cost increases with the font size QH for high turnover fonts more than for low turnover fonts. Yeah, because high turnover fonts are more sensitive, yeah, to the font size. Yeah. Okay, just to summarize our empirical prediction, and then we're gonna shift to the empirical part. It's like for prediction one, we show that font turnover correlates positively with a short-term value added and negatively with long-term value added. Yeah, because a font specializing in short-term will choose a high turnover strategy. Yeah. And the prediction two tells us the font turnover correlates positively with the annual return of the font's short-term holdings before price impact cost. So that's about the alpha. And prediction three tells us the font turnover correlates positively with the price impact cost, like I have just shown before. So now we shift to the empirical part. Yeah, for the empirical part, yeah, we use the transaction data provided by external or Abel-Noether solution. Yeah, because usually the transaction data are highly confidential. Yeah, but for external, the transaction data have a unique identifier for each font from 1999 to 2010. So this gives us a chance of doing a font level analysis. So thanks to the methodology shared by Booth, Cawley, and Jiang and Tang 2020, yeah, we are able to merge the quality holding data with the transaction data and reverse engineer the identity of a small sample of US fonts. So the quality holding data we use is from the Thomson-Reuters mutual font database, and the font level data are from CRISP, and also stock data are from CRISP. So here we use this methodology to construct a daily holding data for a relatively small sample of US active equity fonts. Yeah, we use a more strict rule, yeah, than what they did. So we end up with a smaller sample of fonts, a higher matching quality, that we have a 332 fonts in our sample. So in terms of the matching quality, yeah, basically we can say like when we compare the changes of the quality changes of holdings, yeah, between implied from the Thomson-Reuters quality holding data and that implied from the external data, we can see like 95.9% of the changes in quality holdings from these two data sets matched in direction. That means like if it's a buy in Thomson-Reuters, it's also a buy in external data. And 64.6% of the quality changes of holdings match in the exact number of shares changed. So if a fund buys 200 shares of IBM based on Thomson-Reuters, yeah, that's also 200 shares purchase of IBM based on external. So as high as 64.6% of the quality changes of holdings have exact match of the number of shares. And then we also compare the turnover in external data with the implied turnover from the Thomson-Reuters quality holding data. And we see that the turnover or trading amount implied from external is 20% higher, which is consistent with the 20% intra-quarter round-trip trades documented in Elton, Gruber, and Blake 2011, and also also consistent with other papers using external, like Parkin and Yan, 2011. Yeah, they also show like around 20% of intra-quarter round-trip trades.
Ryan, can I ask a couple of questions on behalf of the audience? So Darwin Choi has a question saying, your propositions rely on the equilibrium that the future expected net alpha is 0, but in the data that is not true. So do your predictions still hold?
The future net alpha, I think there are still some debate in like what's the equilibrium or like the empirical result on net alpha, right? Yeah, from me and my co-author, like from the paper like Berg and Van Binsbergen 2015, they document like a net alpha very close to 0 using Vanguard's benchmark. But on the other hand, I know that for the other papers using like CAPM and also like traditional pharma French 3-factor, 5 factors, some of them document like a negative alpha, on that. But I think the one consensus is like on average, the gross alpha that are documented before the fees are positive. Some are significant, some are not, but they're mostly positive. I think that is one, at least the most important, empirical results like we rely on.
Okay, there's thank you. There is another question from Yua Tang. There are other factors that could affect the choice between short-term versus long-term opportunities. For instance, signal precision could be different for short-term versus long-term opportunities. Limits to arbitrage due to flows, as in Schleifer and Vishny 97. Or with long-term strategies, the fund also needs to worry about portfolio disclosure.
Yeah, I agree. So there are definitely other factors affecting that, but the empirical result we're gonna document and we're gonna show you is that the specialization and the skill at different investment horizon is definitely one of the most important factors determining that. So we're not ruling out the possibility of other factors deciding the horizon. Basically, we have another model, which is a more comprehensive model, that takes another factor, maybe not all of the factors Yuhua has mentioned, but like another factor is about the surviving of fund managers into account. That will also indirectly affect the choice of investment horizon. But for this paper, we focus on what we call horizon-specific skill. That is we see one of the main factor that's driving this.
Thank you.
Yeah. Okay, then we'll continue with the data part. So now I've shown you that we're working on 332 active equity mutual funds, with very high matching quality between the quality holding data from Thomson Reuters and the external data. So, and it's a complete, relatively complete based on the percentage of intra-quarter trades. And this table shows the summary statistics of our sample in panel A, and also the sample in panel B, and for all the equity funds in the Crest mutual fund database. So we can see that for most of the characteristics, like stock holdings, cash holdings, turnover, expense ratio, management fee, fund age, and also the weighted average fund net alpha or fund net returns, they're quite similar. So, but there is one big difference, is like our sample is slightly larger in terms of fund size compared with the average sample of Crest. This is also documented in other papers using external data for the analysis. So for the method of decomposition, so here is for the empirical decomposition. We decompose the fund's value added based on the past length of its holdings, basically. So for each fund on each day, VAT here stands for the value added of that fund on day T, and we decompose it into the first term. Here, the HI T-1 stands for the holding of stock I at the beginning of day T in dollar amounts. And the RIT is the abnormal return of the stock I on day T. And the second term, VIT, is a trading amount of stock I on day T, which is positive for purchase and negative for sales. And REIT is the return from the execution of the trade to the end of the day, for that stock. So here is like if you buy a stock which outperform, that adds value, or like if you sell a stock which underperform, that also adds value. So here because we're gonna decompose based on holdings, and holdings are essentially net purchases in the past days. So we distinguish purchases and sales. So for the trades on the same day, we distinguish the purchases and denote it as BIT, and we denote the sales as a SIT, which is negative. And for the holding at the beginning of the day, we decompose the holding of each stock based on the net purchases in the past N days. So here, for example, for the holding of stock I at the beginning of day T, we decompose it into the first term from the net purchases in the past N days, which basically is the current holding that is shorter than N days, right? So that's a decomposition based on the past length of holding. And the HLN here stands for the holding which has already been in the portfolio like n days ago. So that's the long-term holding. And here, using this equation, we can decompose the actual holding at the beginning of each day into the holdings shorter than n days and the holding longer than n days. So even if we write equation 21, we can decompose the value added into the first two terms in the brackets. Like those are the value added from holdings shorter than n days, including the purchases on the same day and the net purchases in the past n days. And the second term is from the holdings longer than n days. And the third term is just for the sales on the same day. But the effect of the sales is negligible on the same day. And then we vary the number of day n from 1 to 240 days. For this decomposition, we can calculate the value added from their holdings shorter than a certain time period. So using this method, the first.
Can I ask you a question?
Sure.
Yeah. So there's a question from Yuha. What's the intuition with the separating equilibrium in the model that short-term managers continue to invest in short-term opportunities? Is this by assumption that a manager is endowed with skills only at one horizon, short or long?
Yeah. So here is like in our model, because we assume a time constant alpha for each fund, right? So we have a time constant alpha S, that's a short-term alpha for that fund, and also time constant alpha L for that fund. That's because we're focusing on the specialization, right? So that fund is either specializing at a short-term or long-term. We're not focusing on how a fund could potentially start with a short-term skill and later develop themselves into like a long-term skill. Yeah. So by assumption, we have the skill at different horizon. Yeah, that is time constant. And then the endogenous choice of their horizon, their endogenous choice of investment opportunities, like short-term or long-term opportunities, is a function of their alpha opportunity. Yeah, and then it is also constant over time in our model. Yeah, because we're focusing on the heterogeneous skill. Yeah.
So there is another question that's popped up from Juan Pedro Gomez. That another factor is investors' horizon. Short-term investors make long-term strategies risky and negative NPV projects.
Sure. So I didn't completely get this question. It's like a short term. Yeah.
So I think Juan can comment more, but I think the way I read it is that the investors in the funds can also influence the horizon of the fund manager. So if there are short-term investors, that could make long-term strategies more risky and negative NPV. That's the way I read the.
So I think it's like for some fund they have a short-term retail investors investing in them. Is that the case? And that will affect their strategy. So I agree. Right. I think this one is quite related with the earlier question from Yuehua. It's like there are other factors affecting their investment horizon, right? So their client is also one of them. But in our paper, now we're focusing on their horizon-specific skill. Yeah, but those, I agree, that those other factors are also affecting at the same time.
So Juan confirmed that the question, the way I interpreted it was correct.
Okay, perfect.
Yeah, I think, just to add to it, I think it's possible that there is some kind of, like what you do is, in terms of your previous response, if the fund manager is specializing in a certain horizon, like you could also think maybe the investors also somehow match, which type of fund they want to invest in. So if you are a short-term investor, you might go into a short-term fund.
Yes, I think I agree that the fund also will adapt their strategies to their investment, like their clientele, like their investors. Yeah, I definitely agree. Yeah. And I think that's interesting to also take that into account. And then hopefully that won't make our model too big. Yeah.
Thank you.
Thanks. Yeah. Okay, and let me first show the first empirical question. So first show the first empirical result. So I first show the empirical result that's supporting the premise of our model is like there are horizon-specific skills. So we show that funds add value at different horizons, that holdings of high-turnover funds add substantial value in the first 2 months. So that is JS star ahead is larger than 0. Yeah, the short-term guys add value through their short-term holdings, and the holdings of low turnover funds only add value at longer horizon. That's they add value through their long-term holdings. Yeah. So in this figure, we show the value added of a high turnover funds, yeah, from their holdings shorter than 10 days, 20 days, 40 days. Those are business days. So here 120 business days is about half a year, and the 240 business days is about a year. So we show the value added of high turnover funds from their holdings shorter than 1 year. And on the left side, I show the value added in $1 million. And on the right side, I show the corresponding annual growth alpha in percentage, yeah, which is basically the value added divided by the fund size. So we can see that for high turnover funds, their holdings shorter than 40 days at as much as more than $6 million per year. Yeah, for the funds, that corresponds to about 2% of annual growth alpha in percentage. And that represents the majority of the value added like within a year. Yeah. So this one is based on CAPM. Yeah. And we use a CAPM model because like there are papers like Bergham, Van Binsbergen, 2016, and also like Odin, Barber, Odin, and Huang showing that retail investors like chase CAPM alpha. Yeah, they regard other value factor or other things as alpha instead of like a risk factor. Yeah. And different from the high turnover funds, for low turnover funds, we find that their holdings shorter than 40 days almost do not add any value. Yeah, for the low turnover funds, we can see the value added from their holdings shorter than 40 business days is almost constant at 0. And it becomes slightly positive since 50 business days, but stays statistically insignificant most of the time within like a year. Yeah. So to show the result of long-term holdings and also other results more comprehensively, this table shows the value added of low turnover funds and high turnover funds from their holdings shorter than 240 days, holdings and also holdings longer than 240 days, based on 3 different models: CAPM, Fama-Friend 3-factor, Fama-Friend Carhar's 4-factor model. And in panel B, we also report the contribution to funds annual growth alpha in percentage, in case like you believe in alpha more than the value added. Yeah. So the first result is consistent with what I have just shown in the figure. Is like the high turnover funds value added from holdings shorter than 40 business days is very large and significantly positive, while low turnover funds value added from holdings shorter than 40 days is almost at 0. Yeah. And for low turnover funds value added from holdings longer than 240 days, yeah, the amount is substantial. Yeah, basically they're holding for low turnover funds holdings longer than 240 days, that's about a year, at as much as $62.9 million per year for the low turnover funds, while the long-term holding, like holdings longer than a year of a high turnover funds, even destroy value. Yeah, that means those holdings underperform the CAPM benchmark. Yeah, even though it is not statistically significant. Yeah. So this is confirming our our prediction and also like our assumption, like there are short-term skew for the high turnover funds and the long-term skew for low turnover funds. And here, then what we do is like we compare the result between CAPM model, Fama-Friend 3-factor model, and the Fama-Friend 4-factor model to understand more about the sources of value added. So what we find is like low turnover funds long-term value added are largely from their exposures to the value factor, while high turnover funds, short-term value added are largely from their exposures to the momentum factor. So as we know that value factors are relatively long-term strategies and the momentum is relatively short-term strategy. So this result is consistent with our argument. Here we can see after we include the value factor and size factor into the benchmark and use the Fama Friend 3 factor, we can see the low turnover funds value added from holdings longer than a year almost disappear. Yeah. And we also do another analysis to show the average stock characteristic quintile of holdings. So for the book to market ratio, for stock cap, and also for momentum, yeah, we can see for all funds, they're relatively neutral in terms of holdings. So they have the average quintile of 3 for all these 3 styles. But for low turnover funds, we can see they tilt their portfolio towards value stocks. That's a high book to market ratio stocks. But on the other hand, they also tilt their portfolio slightly towards large cap stocks. So that means they're mainly profiting from the value factor instead of the size factor. So that's why we say the value added is largely explained by the value factor. Yeah.
So Ron, this is interesting, but I just was wondering that your Fama Friend, if you look at the high turnover funds, you do see a drop in the alpha when you go the 4 factors which controls for momentum, but there is also a drop even with the 3 factor alpha. So it seems to be like a...
You mean here?
Yeah.
Yes.
And then another thing I wonder about is that these are very short horizons, while the traditional momentum strategy, at least the way the Ken French's website would do, is require you to hold it for 11 months. So I'm just trying to understand how these things map with each other.
Yeah, so for momentum, indeed, we find a little bit of mismatch. Yeah, so I will show here, like basically for momentum, that is, maybe I will just jump to here. That's is easier. So here it shows the value added of a high turnover funds from their short-term holdings within a year for both CAPM, Fama Friend 3 factor, and the Fama Friend cohort 4 factor. Yeah. So we can see based on the CAPM and the Fama Friend 3 factor, their value added, like from their holdings shorter than a year, like stay positive and very large. But after including momentum, we can see the value added decreases a lot. So as Vikas mentioned, it's like for momentum, the biggest effect is at the horizon of about a year. We can see value added from their holdings shorter than a year decreases and explained largely by the momentum. But on the other hand, actually their value added within 40 days, is explained a little bit by momentum, but not much. Yeah. So like Vikas mentioned, it's like there is indeed, we use momentum as an example, but momentum is not like a completely like 100% short-term investment strategy. Yeah, because it also has a horizon of about several months or like up to a year. Yeah. But at least for high turnover funds, we find that they indeed have positive exposure to momentum. Yeah.
Yeah. So I had another sort of follow-up sort of clarification. Like when you think about mutual funds, you typically don't think of momentum funds. Like no fund calls itself a momentum fund.
While that's true. Yeah.
You do see size, value, all these kind of things. So I was just trying to understand whether, what's the character. It might be worthwhile thinking about what do these high turnover funds call themselves? Like, I suspect some of them might even call themselves value fund, and then they are doing this. Like, how should I think about this?
Yeah, from my perspective, it's like they definitely, on one hand, claim they are using other strategies, but from our data, we see like whatever strategy they use for the extremely low turnover funds, they have very high exposure to the value factor. Yeah, and also for the high turnover funds, they definitely do not call them momentum funds, right? But their value added also have a relatively high exposure to the momentum factor. But like you mentioned, it's like for the very short-term value added, those are not explained by momentum. Yeah, that's by other factors. So one interesting result is like actually it's not the focus of this paper, but like we also find like for those medium turnover funds, those are slightly high turnover or like slightly low turnover, they are profiting more from the strategies we do not know. So they have some exposure to the value factor and also some exposure to momentum factor, but they are more skilled in terms of using other strategies to extract alphas. But because we do not know what they are, and we didn't really focus on that in this paper. Yeah.
Thank you.
Yeah, thanks. Yeah. So I think I have covered this part quite well. So let's turn to the formal test of our predictions. Yeah, which is already covered a little bit in the previous results, but now we do a more formal test on that. So for our prediction 1, we predict that the fund turnover positively correlates with the value added of short-term holdings and negatively correlates with the value added of long-term holdings. Yeah. So here, what we do is like we calculate the high turnover funds value added from their holdings shorter than 1 year. The differences between high turnover funds value added and low turnover funds value added from their holdings like shorter than 1 year and also like holdings longer than 1 year. So here we could see that on average, the high turnover funds profiting or adding more value through their holdings shorter than 40 days compared with the low turnover funds. And based on value added, it is significant at the 5% significance level. And for holdings longer than a year, the high turnover funds actually add less value compared with low turnover funds. So here it reports the differences. So the high turnover funds add $64.8 million less value from their holdings longer than a year compared with the low turnover funds, and which is significant at a 10% level. Yeah, but we know that also mentioned in Berg and Van Binsbergen 2015, like the value added has actual kurtosis, so that will very likely decrease the significance level. So they also rely on another test that is based on the order statistics, and we do the same. So here what we do is like we report the frequency of days that high turnover funds has a higher value added than the low turnover funds. Yeah. So here on average, if the high turnover funds do not are not more likely to add value, then the frequency should be 50%. So in 50% of the days, high turnover funds have higher value added than low turnover funds from their short-term holdings. But from the results reported here, we can see like for holdings shorter than 60 days, the high turnover funds in 52% to 53% of the days have a higher turnover, have a higher value added than low turnover funds. So that means indeed high turnover funds are more likely to profit from their short-term holdings. So if we use this order statistic for the test, we get a stronger testing power. So the result is significantly mostly within 1 to 2% significance level. And the same for holdings longer than a year. It's like once we use the order statistics, we find that out of about 48% of the days, high turnover has a value added from holdings longer than a year, more than low turnover funds. So that means low turnover funds are more likely to profit from their holdings longer than a year. And this test is significant under 5% level. Yeah. So now we turn to our second prediction, which shows like the fund turnover positively correlates with the abnormal returns of funds short-term holdings before price impact cost. So from this equation, you have learned, sorry for that. So from this equation, we show that if a fund chooses the short-term investment opportunity, that is because the short-term opportunity gives better value added. And that's only the case if the short-term opportunity has a higher alpha. Yeah. So here, to calculate the alpha before price impact cost, we first use the execution shortfall of trades as a measure of price impact cost, which is also used in Busa, Claudia, and Jiang and Tang. and also in other papers using transaction data, yeah, which is the price changes from the P0, that's the stop price at the order placement, to PE, that's the price of the actual execution price, yeah. And then we use the execution shortfall as a measure of the price impact cost, yeah. So, and then what we calculate is that we use the alpha SN as, which is the value weighted alpha of all the holdings. Yeah, that's the net purchases shorter than N days. Yeah, before the execution shortfall of trades. Yeah, so we use the alpha before the execution shortfall of purchases, basically. Yeah, for the holdings shorter than N days as a measure of the short-term alpha. Yeah.
Ren, there's a question from Jerry Gay. Does the high turnover result in higher short-term taxable gains or losses that may affect the actual alpha that the investors receive?
High turnover in short term. Sorry, can you say that again? So high turnover.
Yeah. So let me kind of rephrase it. So I think what Jerry is asking is that, you know, when the fund manager is turning over the portfolio more often, then it can potentially result in short-term taxable gains and losses, which are going to be passed on to the investors and will affect the actual alpha that the investors are earning. That's my interpretation.
Okay, yeah. So let me think. So now what we are documenting is the again from the fund managers, right? So that's the gross alpha, and what passed to the investor is a net alpha, right? So that's after the fee, and after and the taxes and of the gains and loss should also be part of the gross alpha, right? So yeah, if that's the case, I think I understand the question. Yeah, I think that is also captured by that is also captured. I think yeah, because what we document is like we measure the profits by the gross alpha. So that is after the taxes on the gains and the losses, right? Yeah. So in that way,
I don't think the taxes would be included. If I understand correctly, the net alpha would be net of fees, but it would not be net of taxes, because whatever taxes are applicable, they are going to be passed on to the investors, right? So
okay, yeah, okay.
so
yeah,
I think in your world you're kind of pre-taxes, but in a world where investors care about taxes, I think definitely they would, you know, I suspect that, you know, some of these high turnover funds, I mean, Clemens was in the audience, he's done work on tax managed funds, for example. Like,
okay,
I don't know, which are also doing high turnover are also doing something to manage taxes. Might be worth thinking about to, you know.
Yeah, I understand. Yeah, for me, like indeed, I haven't done work on that, so I even do not really know that whether the taxes are from the investors side or like the fund manager side. I think there are taxes on both sides. Yeah, for our work now, it's definitely before the tax on the investor side. Yeah, but that should be after the tax on the fund manager side, if there are any. Yeah, so yeah, I think we didn't take the tax on gains and losses into account. So that's definitely one thing that we should take into account. Yeah, for our research.
Yeah. Funds are passed through vehicles, so basically the tax liability gets passed on to the investors, right? So.
Okay. Yeah, I agree. Yeah, I will have a look on that. Thanks. Yeah. Okay, and then go back to the alpha opportunity. So what we show here is like the alpha opportunity, that's the annualized alpha of high turnover funds holdings shorter than 10 days, 20 days, up to 120 days and 240 days. Yeah. So here is, and we can see that for the holdings shorter than 10 days and up to like 30 days, they have substantially higher alpha than the holdings like shorter than half a year or a year. So it decreases sharply at the beginning and also gradually later, like within a year. So that means like high turnover funds are actually profiting quite have a higher alpha, yeah, from their their short-term holdings. And on the
So,
other, yeah.
Just to add, so Clemens clarified it. So this is from a tax expert. So I think taxes are most often not included in net returns. One exception is the withholding taxes for international funds. So that was my understanding was that net returns don't include taxes. So.
Okay, I got it. Thanks. Yeah. Sure. Okay. And then for the alpha opportunity, we can see that for high turnover funds, the alphas of their short-term holdings are pretty high. But on the other hand, for low turnover funds, their holdings shorter than 40 or 50 days almost have no alpha or zero alpha before the price impact cost. Yeah. So that means they're actually profiting from a different type of investment opportunities. Yeah. And for low turnover funds, we can see their holdings longer than 50 days at a little bit of value within a year, but not much, not statistically different from zero. So we also did a formal test on that, and that shows like high turnover funds have a higher alpha from their short-term holdings than low turnover funds, using both the alpha and the order statistics. So now turn to the price impact cost part. I would say that's one of the most interesting part, is that we show that turnover positively correlates with the price impact cost, both before and after controlling for fund size. And that is illustrated by this equation here. Yeah. And moreover, we show that price impact cost increase with fund size for high turnover funds more than for low turnover funds. Yeah. So here in this table, we show the execution shortfall as a percentage of trading amounts. Yeah. And in panel A, we show that by turnover quintile. So we have a quintile 1 for low turnover funds and quintile 5 for like high turnover funds. And here we can see by taking the differences between high turnover funds and low turnover funds, quintile 5 and quintile 1, we can see high turnover funds has an execution shortfall about 57 basis points higher, yeah, which is significant at 1% level. And interestingly, we find that for low turnover funds, they even have a negative execution shortfall on average. That means they are even providing liquidity while executing their trades. Yeah. And for panel B, we sort the execution the funds based on both the fund turnover and the size quintile and report the average execution shortfall. So we can see like consistently, we find that even controlling for fund size, we find that high turnover funds have substantially higher price impact costs than low turnover funds. Yeah, consistent with our prediction. And moreover, we find that the large funds have higher execution shortfall or price impact cost than small funds only for the high turnover strategies. Yeah, so that is also yeah.
Ren, I had a question about this. This is quite interesting, the execution shortfall being negative. So I'm trying to like reconcile this with your earlier comment that these guys might be using momentum strategy. So if you think about a momentum strategy, that's actually very high transaction costs. So I don't really,
yes.
I was just trying to understand like how can these guys have a negative execution shortfall when you are trying to,
use a momentum strategy. Yeah, so for I think because what we show is like high turnover funds follow momentum strategy. So for high turnover funds, they have positive execution shortfall. But for low turnover funds, they are following value strategy most of the time.
Sorry, I misunderstood. Okay, yeah. So
yeah.
So is this? So they can still make money despite the fact that they are doing momentum strategy despite the high transaction costs.
You mean make money from the execution? Yeah,
no, from the trades, right?
Yeah, from the trades, yeah, they're using momentum and they still make some money within a year. That's true. Yeah, but during the execution, yeah, only low turnover funds are making money. Yeah, from providing liquidity. Yeah. Okay. Yeah. And now let me use the last bit of time to turn to the relation between fund size and trading cost, and also the relation between fund size and turnover. So once we focus on fund size, another setting in Burton Green is very important, because in Burton Green, they allow a fund up to invest in a part, invest a part of its capital, that's QI, in a passive benchmark. And like they allow the fund to index part of their benchmark, part of their capital. So because of that, we have the total fund size Q, including two parts. The first part is QH, that's the active part invested in investment opportunity H, and the second part that's invested in the index. Then if we do that, the growth alpha of the fund will depend not only on the alpha opportunity, but also on the size, the total size, including the passive part and also the price impact cost. So the same as the previous result is like once we allow rational investors chase any positive net present value, we will have a zero net alpha, and then the fee will equal to the gross alpha in this setting as well. So here, if we allow the fund pick this fee f equal to the optimal level for the active part, that's AH divided by 2, we have exactly the same setting as before. Because the fund will choose to invest all the money as a QH star into the active investment opportunity. But what Burton Green points out is that it is optimal for the fund to choose any fee f smaller than f star, that's A divided by 2 here, to raise enough capital for investing. That tells you that the fund can choose to invest QH star themselves into the opportunity H and index the difference. So they are still investing enough money into the active investment opportunity and profiting from the value added. So under this framework, the equilibrium fund size Q here can be written as only a function of the value added of the fund and fee. So based on this equation here, the fund size correlation with price impact cost, which in equilibrium only depends on AH, the alpha opportunity, and fund turnover, which is revealed by the price impact cost BH here, are ambiguous because the fund size is only a function of the fund skew GH star here. Because the funds can either be specializing in short term or long term, so they can have a large value added by being either a short term investor or a long term investor. So there is no guarantee that the short term guys have a higher alpha or like the lower price impact cost than the long term guys. So this result is quite consistent with what has been documented in Busa, Caldian, Jiang, and Tang in 2020. It's like what they have shown in their paper. When we sort the funds by the fund size, we also find that the execution shortfall has a non-monotonic relation with the fund size. So when we take the differences between the execution shortfall of large funds versus small funds, we can see the differences is not significant. But what Busa, Caldian, Jiang, and Tang argues is like larger funds trade less frequently and hold bigger stocks to avoid incurring higher transaction costs, which I totally agree. We want to say like our model provides an additional explanation from the investor's perspective. Because in equilibrium, the fund size depends on only the fee and the scale, which is measured by the value added, and that has taken the price impact into account. So that means when the investors chooses the capital to invest in, they have already taken the price impact cost into account as well. So that means.
Rand, we are, I think, almost out of time, but you had just a comment on the execution shortfall, that the magnitude of execution shortfall will depend on what benchmark price you use in the calculation, whether it's a prior closing price or opening price also. So But you
Yeah,
have a
sure.
few minutes to wrap up. I think it's almost time.
Yeah, yeah, sure. I will do that. I'm also almost finishing. For execution shortfall, like we tried the different methods, like using an open price or a closed price, and that didn't have a big effect. And so it's consistent with like a result in Booth Kaodian Jiangtang. Like they also used the open price and the price at the submission of the order, and then like there are not big difference between them. Yeah. Okay, so for this result, what we want to focus on is like, on one hand, funds are adapting their strategy to the price impact cost. On the other hand, the investors have already taken the price impact cost into account when allocating capital. So that's why there is no clear result between fund size and execution shortfall. Yeah. Okay, for the sake of time, yeah, I will just skip the result for fund size. But basically what we are arguing is like the relation between fund size and the execution shortfall, and also the value that they add at different horizons are ambiguous. So let me conclude. It's like we find funds choose their turnovers based on their horizon specific skill, which is measured by value added. And the value added has taken the horizon specific price impact cost into account. And consistent with our model predictions, we find that holdings of high turnover funds add substantial value in the first 2 months, while holdings of low turnover funds mainly add value beyond a year. And price impact costs of high turnover funds are substantially higher than that of low turnover funds. Yeah, and lastly, the fund size correlation with price impact cost, turnover, and the horizon over which value is added are ambiguous, at least based on our model. Yeah, thanks. I think that's all for my presentation.
Thank you very much, Rand.
Thanks. Yeah.
I'll open it up for more questions. If people have additional questions, they can also. So there is one question from Meng Wang here. If I understand it correctly, holdings of low turnover funds mainly add value beyond a year. And the reason why funds would hold those assets for a year instead of buying assets later is that they want to spread the trading cost over the whole year. So his question is the saving on trading costs large enough to compensate for potential opportunity cost?
Yes, I think that's a good question. So we haven't done that improve identification ourselves. Yeah, so what we are doing here now is only documenting the value added at different horizon. So it will be interesting to look into that, like why they're holding it for such a long period. Yeah, I think that's a good way to go. Yeah, I'll make a note. Yeah. Thanks.
So are there any other questions? If not, we can, of course, upload this great presentation virtually. And I'm going to stop the recording at this point. And as I mentioned at the beginning, we'll keep the Zoom room open for another 15 minutes. And you're welcome to stay back and have an informal chat with Ranshane. So thanks again for attending the talk, and we look forward to your continued support.
Yeah, thanks.